Well, hello and welcome to this Friday edition, not Thursday where it should be, Friday edition of the Status Chat, 12/5/25, episode 283. Title is December Fed Cuts Loading, Good News or Bad Ideas. Now, you can find our Status Chats at the Status Chat playlist over on the YouTube page where they all live. And if you are listening on a different platform, you might see a copy of it there rather than going to that list. Now, we did take Friday or last week, Thursday of last week off because we weren't really feeling all that spry, and it being a holiday week and a lot of people in and out, we thought we would just give it a rest. Now, we're not up to full strength. We're not all that pumpkin right now, but we are back at it a day late and maybe, who knows, $1 short. We won't take that too personally. So I got a lot of stuff loaded for you. I think is going to come at you awfully quick. We're not going to do a lot of reading because I don't have the voice for it. And right now we don't want to spend that much time with it. We just want to hit you with something that you can be aware of so that you are up to date, so to speak. So let's go to our center panel. And we have our FHFA, or the Federal Housing Finance Administration, I believe is what it is. Federal Housing Finance. See, they left the last part off, didn't they? See, this branch of government was brand new right after the great financial crisis. Now, what was so great about the financial crisis? I didn't make any money off of it, but I'm sure a lot of people made billions off of it. Other people lost those same billions that were made. Now, it was created to make sure that the GSA, the government-sponsored enterprises, would never again do stupid crap and jeopardize the mortgage markets and housing markets and all that kind of stuff that happened when things went in the pooper. That's why we made it. And we set it up so that it wouldn't be political and it wouldn't do stupid stuff. Is there solely to protect finances, not to do diversity equity, which is what the previous administration introduced when they were doing some things under Sandra L. Thompson. Now we've got somebody else running it, and we'll see that, I believe, right here when this man's name is quoted, if not here, other places. But FHFA announces conforming loan limit values for 2026 up about $26,000. Somewhere it tells us there it is, $26,000 higher than they were last year, to be $832,750. So that's a bunch. You can look this up if you want to. It is the U.S. Federal Housing, and then you can just Google that. Housing Wire. Fannie Mae. This is one of the GSEs, right? Government-sponsored enterprises. Fannie Mae and Freddie Mac. And Freddie Mac actually has a commercial or multifamily and a single family. But Fannie Mae removes the minimum credit score requirements from Desktop Underwriter. Yes, I read that correctly. You can now get a government underwritten kind of from the government sponsored enterprise with no credit score. Now, do you think that is, I don't know, it may be helping borrowers, but do you think it is helping with removing risk or avoiding risk out of our mortgage markets? What was the FHFA created for? I'll let you Google that so you can see if I'm just being a complete and total nut job. So this bothers me. It's not that I don't want people to get loans, but 620 is a flipping minimal credit rating. It is. It's just that's not very high to start with. Now they're going to remove it after November 16th of 2025. Wow. That is from my, I can't believe they did that department. Well, let's see what else we got here. Well, let's look at what the median sales price of houses sold for the United States. This is with Fred, and you know who Fred is, Federal Reserve Economic Data, and this is out of St. Louis generally. All right, it says this comes from the Census Bureau. It's saying down here at the bottom. And look what we've got going on. We're watching housing pricing going up at sharper and sharper slope until we hit the Rona, the designed by CRISPR gift that just kept on giving, and we see a huge spike in growth of prices, sales prices. They went through the roof. They're beginning to come down, which I personally would think this is sort of a bit of a correction. I don't think if your house went up this much in value, it's going to hurt you that much. Now, if you were someone who moved very recently and bought a house when they were up toward this area, that may be, not as good of a news story for you. But remember, this is the entire nation that we look at to be stable, not just any one family. Not that someone at a family or personal level being in financial straits is a good thing. No, I'm not saying that at all. I'm just saying when we look at it in the macro, not the micro, we see that we had this huge spike that was largely due to Biden spending the money from COVID, which came through. Look at it here. Had we just kept on target, would we have been anywhere up this high? I don't know that we would have. But they spent a lot of money. They printed a lot of it. The interest rates then later came up. So we had inflammation, I will call it, in housing prices, followed by inflammation of the interest rates. And what are interest rates? We'll get to that later on. Let's look at this tag. The FHFA director, Bill Pulte, is exploring a 50-year mortgage to boost housing affordability by lowering monthly payments. We covered this in a previous episode, but housing experts warn it could cause total interest payments, delayed equity, building, and raise long-term costs, with some officials suggesting lower rates might negate the need. Well, that comes from our should be obvious if you passed your math classes. Anytime you stretch the payment out on time, you're borrowing somebody else's money. We've covered this. It's going to hurt you. When you take it from 20 to 30, it's a big chunk. You take it from 30 to 50, it's going to be a lot more sensitive to fluctuations in market values because you're paying virtually nothing, especially if you have low to nothing on your down payment. You're really counting on the growth in equity that is a combination of what you've paid off and, of course, the increase by inflation. And if you see deflating prices, that might be a bad thing. So I don't know if that's a good idea or a bad thing. If you need to buy a house and you're aware of this and you buy a house and just as soon as your fortunes change, you get out of that situation, that may be a good thing. I can't really put a good or bad on stuff because we're all different people in different stages of our lives and in different desires and job places and where we got to move and that kind of stuff. We just don't know. It's something you have to do on an individual basis. So let's take a look at this. We have Fed Watch because part of the title was, you got it, rates loading, cuts loading. So here we are. Here at CME Fed Watch tool, it has now flipped the script from being majorly on the keep it same to majorly 87.2. This is their prediction that we will see a cut in the Fed rate, which doesn't change mortgage rates at all. But it may, and it does, on average, affect the cost of money for business and the economy in general. Let's check out, see what our mortgage rates are according to our friends at Mortgage News Daily. I like these people because they give us this real janky daily rate as well as giving us the weeklies that come by. And we can just see from the general trend since the first of this year, we have dropped mortgage rates. A lot of different things play into this. Mortgage mortgage securities, confidence in the market, what we think we're going to do, the overall belief that we're going to keep lowering money. All kind of different things are lowering the rate. And as always, before we get to our numbers, we want to remind you to smash that subscribe button and get on board with our presentations. But let's get to those numbers. Now, last week we didn't take them because I was under the weather, so we're just going to use the one reference point and reference the direction from the previously recorded numbers. This week, 12/05 of 25, we saw 26,186 was the availables. That was down over the previous period, which is 2 weeks ago. We have 43,948 in the under contract still showing. That also decreased a little bit, and the ratio increased to 15% between those two numbers. So I guess that's all we need to hit, short of let's find us some words of wisdom.